I am now. Exactly what I'm doing. Class 7 of 20. Yeah, well, hang on. All right, sent the tweet. All right, tweet sent. Video's good. I can hear it. Tags are good.
Welcome back, guys. This is Mike with Vant Trading Class 7, titled The Holy Grail Part 2, Risk Management. Really excited to go with you guys, talk to you guys about this. I know yesterday's class went a little bit long. Believe it or not, it probably could have went a lot longer. You know, I know we had some technical difficulties as well, but I think everything is good. So it's probably a lesson that a lot of you are going to have to go over and over a couple times. There was a lot of information packed into that lesson. And I think we got a lot of information packed into this lesson. So today and tomorrow, we're going to finish up on this risk management. You know, tomorrow's position sizing, today's risk management. And, you know, they kind of go hand in hand, just like, you know, when we talked about emotional control and self-control, kind of goes hand in hand here with risk management. So again, guys, listen, what you are getting, okay, in these classes over the first 2 weeks is truly the most important part. It's the secret to trading. Okay, that's why we call it. That's why I'm calling this class Holy Grail Part 2, because, you know, the secret is there's no Holy Grail in the terms of how traders are typically out there looking for that Holy Grail. You know, I know a lot of people have dropped off this course because, you know, we haven't talked about charts or setups and indicators and all that other crap, right? That doesn't mean anything. Okay, take it from us. We're professional traders. We do this for a living. Okay, what we're in the middle of is the most important part for trading. So I want to start off today's class with a little Les Brown. Okay, a little video.
In the Far East,
on Les Brown.
they have something that's called the Chinese bamboo tree. The Chinese bamboo tree takes 5 years to grow. And when they go through a process of growing it, they have to water and fertilize the ground where it is every day. And it doesn't break through the ground until the 5th year. Okay? But once it breaks through the ground, within 5 weeks, it grows 90 feet tall. Now the question is, does it grow 90 feet tall in 5 weeks or 5 years? The answer is obvious. It grows 90 feet tall in 5 years, because at any time had that person stopped watering and nurturing and fertilizing that dream, that bamboo tree would have died in the ground. And I can see people coming out talking to a guy out there watering and fertilizing the ground that's not showing anything. Hey, what you doing? You've been out here a long time, man. And the conversation in the neighborhood is, you growing a Chinese bamboo tree, is that right? Yeah, that's right. Well, even Ray Charles and Stevie Wonder can see ain't nothing showing. You know that's how people are going to do you? So how long you been working on this? How long have you been working on your dreams? And you have nothing to show. This is all you got to show? People are going to do that to you. And some people, ladies and gentlemen, they stop. Because they don't see instant results. It doesn't happen quickly. They stop. Oh, no. You got to keep on watering your dream. And when it began to happen, they stopped laughing. They said, look, whoa, look here. Look how, hey, man, you know, I know you could do it. Look here, you got a job here? See, during those hard times, we didn't know how you're going to make payroll. During those times when you failed and things didn't work out, they were nowhere to be found. But you know what I discovered? When you're working at your dream, somebody said the harder the battle, the sweeter the victory. Oh, it's sweet to you. It's good to you. Why? See, when it's hard and there's a struggle, see, what you become in the process is more important than the dream. That's far more important. The kind of person you become, the character that you build, the courage that you develop, the faith that you're manifesting. Oh, it's something that you get up in the morning, you look yourself in the mirror, you're a different kind of person. You walk with a different kind of spirit. And people know that you know what life is, that you have embraced life. You knew it was hard, but you did it hard.
All right, guys. I really love that that clip there. Les Brown, he's awesome. Pulled that off YouTube. So if you guys get a chance, look up Les Brown. He's really a good motivational speaker. And I thought that was kind of poignant for where we are. This is really probably one of the toughest weeks that you're going to have through the education process. And so, it can really get to be a grind. And so, the key is you're not, and it's so poignant for what really is going on with trading, right? Because when you're trading, trying to learn to trade, it is going to be a grind, man. Even with the advantage that you guys are going to have going through this course, it's going to be a grind, and this week is the grind of all grinds. So, even though you may not be seeing the results right away, and even in trading, man, when you start trading, you may not see profits right away. Matter of fact, I guarantee you're not going to see profits right away. But, the key is you're really, it's growing there, and your skills are growing, and you will, you are becoming, you got to trust the process. You will be becoming a good trader. So keep the grind up, keep it going. Okay, now the habit this week, again, mindfulness. Okay, every battle that takes place, whether within the body and mind or outside it, is always a battle against oneself. Okay. And mindfulness, again, a mental state achieves by focusing one's awareness on the present moment while calmly acknowledging and accepting one's thoughts and feelings. Okay, and we harped upon, we harped upon discipline on week 1. We're gonna harp upon until the end of tomorrow on mindfulness, because it is really an important trait, skill, whatever you want to call it, to being successful. It's the tool to get you through these pitfalls that really we're going through. Now, mindfulness in trading is merely following the market in your system while avoiding extraneous thoughts and chatter. Okay? And when we're talking about mindfulness in risk management, it's the ability to analyze and thoughtfully respond rather than react. Okay? See, most traders' reactions that occur from a trigger is an emotional reaction. Okay, and so with emotions need to be acknowledged. Okay, we talked about this yesterday. Emotions need to be acknowledged, but you cannot control and eliminate them. Okay, and you can't allow them to control the decision-making process. Okay, but the mistake, 90% of the traders that understand this whole emotion issue, they think that, you gotta eliminate emotions. You can't do that, man. You are a human being, and you cannot eliminate emotions. Okay, and so what mindfulness is going to do, it's going to help you reduce your mental mistakes, and it's going to help you control and recognize your biases. Okay, biases such as loss aversion, okay, before they damage your trading. And loss aversion, what was loss aversion? That's where you're more willing to take risks and extend your losses than you are in extending your gains. And we'll kind of talk about that a little bit more as we go. Now, mindfulness in risk management, you need to be able to see risk and dangers for what they truly are. And if you're stuck in the muck, if you're stuck in what I like to call the front lines, right, and your focus is very narrow, you're stressed and you're tense, it's hard to have a top-down approach and look down, because then you can't see the risks and the biases, the instantaneous reactions that are occurring from triggers that you have. Okay, you can't see it that in your environment, and you can't really truly analyze the market environment for the environment that it is. That's why I think it's crazy, man, when traders, they always ask me, and if you watch some of our Zooms and some of our shows, they see a TV in the background and stuff like that, and they're like, Mike, how come you don't have CNN on? We have TVs all throughout the trading pit, but we don't have CNN on. It's really more of a communication tool, right? We want to put something up there for the traders because, we don't need any of those biases or judgments. The only really action I need to understand is market action. We have news sources that people are going through, and we get our news so we understand our headline risk. But really, mindfulness is to be able to just let you stand above and really accept the market action for what it is, pure, and make a determination on what is occurring. Okay, because your biases, what you think about the market, doesn't matter. Okay, it doesn't matter. And importance, the key in risk management is important to keep the core philosophy of risk management, which is, let your profits run and cut off your losses. Okay, but what happens, the disposition effect is, typical traders, especially new traders, they do the exact opposite. Even though most of those traders have heard that saying over and over again, most traders, they don't even realize they're doing it. They cut their winners and then they let their losers run because they get caught up in this whole hope fallacy. Okay, I hope it's going to come back. Right? They have these emotional reactions and they are unable to take and accept a loss. Okay? And when you're talking about risk management, you also, look guys, you gotta have a contingency plan. We're gonna talk later. And to have mindfulness, to be able to have that, think about when something happens, maybe you've been at work before or you've been in another business and something happens that nobody was expecting. Okay, that's really when you see who the true people are. I always have a saying, when you're staring into the abyss, your true character comes out, right? And it's the same thing. When you have something happen, and let's say your internet goes down and you're in a trade, that's where you don't want to have this huge emotional, oh shit moment. And, you want to have a pre-planned, be able to sit above, be relaxed. Yeah, you're going to have some stress, but you already want to have that plan in place and be able to, have mindfulness in how am I going to take care of this issue so I can mitigate my risk. Okay? Because see, when you can be present to only what is truly happening with no judgment at all and in full recognition of your emotions, that's when your trading's going to change. I promise you. Okay? That right there is when your trading is going to change. Okay? And it's something important for people to realize. Now, foundation for long-term success in trading is risk management. Okay? The key, guys, is protecting your account and staying in the game. Okay? What makes me sick is when I look, because I've seen there's so many people trying to sell their courses and sell their wares, selling this day trading educational courses out there, right? And they're selling, so many people are selling this stuff for like $5,000-$10,000. And they got, we talked about the success formula, right? And they're talking about all these awesome Holy Grail technical indicators and systems and how to pick out stocks and all this stuff. Right? And it makes me sick that they don't really spend the time to teach their people about risk. Because a lot of these courses are good, man. A lot of these traders are good. There's a lot of crap out there, but there's a lot of good educators out there, a lot of good courses. But you know what? If you truly care about your traders being successful, then you would actually talk about risk and talk about how to manage it. But people, it's just like a cursory, something that they just bring up and they don't really spend more time on. Okay? So, we're doing this because we truly want to see you guys succeed. We want to create good traders. That's what we're looking for. We're going to have lots of opportunities in our fund, and our goal, we talked about this before, is hopefully we can find some good traders out of the people that go through our courses and the people that we mentor, because then, we're always looking, look, good traders, truly good traders that understand how to be a consistently good trader are few and far between. And so we've taken a tactic. We're going to go out there and try to create good traders. And that's what this course is all about. Now, getting back to risk management, there's two skills that sets, winners apart from losers. Two skills: self-control and risk control. Okay. Now, we talked about self-control yesterday, and we're going to talk a little bit about it today. The reason that we kind of put these courses together the way we did is to really build upon that foundation, right? And really, psychological factors in risk management, they go hand in hand. Okay, they really do. And together, they truly are the Holy Grail of success for being a successful trader. So, when we talk about self-control, that's getting that mental edge, right? Getting that mental edge. And we talked about that. Go back. You're going to have to look at that, redo that course that we did yesterday. Play it over and over again, because, you're going to pick up different distinctions each time. Now, tools and traits that we're going to talk about. Tools and traits that, a lot of traders use to kind of manage these two skills is, we talked about meditation. Okay. And I promise you guys, I'll get a meditation course up there separately from this course, so you guys can pick up on how we meditate. And if you want, if you need more than what I've gone over already in these courses, really I've gone over enough on meditation that you should be starting meditation right now. Okay. Visualization, we've gone over visualization. That is an important skill, guys. You guys are elite performance athletes. Okay, it's 90% mental. Michael Jordan, I love the interview with Michael Jordan. He was one of the greatest, if not the greatest, basketball player of my time. And, Michael Jordan said that he would spend time sitting there just visualizing. He visualized and saw the game before he even stepped on the court. And it wasn't just sitting down for 5 minutes and visualizing. He visualized the whole game. He visualized the moves. He visualized the sweat coming off his face. Okay? You guys, you got to learn this trait of visualization, because we talked about it. Part of your pre-trading routine, part of our pre-trading routine that we do on our trading floor is we have our traders visualize, take some deep breaths, visualize the trading day before they actually hit the floor. Okay, and we talked about this. You guys should already be doing or have done your visualization statement, which is part of your trading plan. That was part of week 1. Okay, now when you go back to that visualization statement, and I told you guys you're going to go back to this stuff. You're going to make it better because you're going to make new distinctions. I want you to add in there the little quirks and things like the sweat. Are you, what's happening while you trade? Are you getting, does your muscles tighten? Do you get shallow breathing? Does your focus narrow? Okay, and then you want to add in there too, what is your plan? What is your plan? Because you want to see yourself doing it, right? So you can't have a visualization statement unless you have your self-control plan and your self-discipline plan right there. And how are you going to deal with these emotions and biases? Okay. Now, another really important skill is good record keeping. Every successful trader is really good and keeps detailed record keeping. Okay, really important. And doing a self-analysis every day, and now you're not just doing a self-analysis on your trade mechanisms and how your trade setups went and whether you followed your rules and how good your trade was. Now you're adding another element, which is the emotional bias. Right? And so you're adding in, what were my thoughts? What were my feelings? What were the emotions that incurred? What did I, and how did it affect my trading? Okay, you got to write that stuff, review it. Okay, and of course, skill, you got to have self-discipline. Talked about it. Kanai, constant and never-ending improvement. You constantly, we talked about a lot of stuff about, a lot of people probably went through yesterday's course and said, man, I'm screwed up, man. I didn't know to be a good trader, Mike, that I was going to have to fix all the crap that my parents instilled in me that's kind of screwed up. I didn't know I was going to have to fix all this stuff, right? Well, look, fixing you, whatever that means, is not, it's not going to happen overnight. Right? Constant improvement is just what it says. It's constantly every day chipping away, getting that momentum. And what I said, guys, momentum is a powerful, powerful tool. It's a powerful, powerful trait. And, you got to utilize this course, okay, that we're doing every day, immersed in it. We're meeting on Sundays, we're meeting in the mornings. Utilize this to propel you, because when we're done the course, we're going to jump right into the personal mentorship portion, okay? The personal mentorship portion, you're going to be able to watch us trade. We're going to be able to watch you trade. We're going to be able to go over your trades, and you're going to be able to watch our trades, okay? And, you're going to have an opportunity of a lifetime to be able to possibly have an opportunity to trade for a professional firm. So if this is your passion, right, and you're going through this course, use it. Make sure you're doing it every day, and you're going and reviewing your notes. You're using your journals. Use it to create momentum. And remember, keep it simple and stupid, and don't let perfection get in the way. Okay? So really, you're not going to fix yourself. You're going to work on that every day as you go forward, and you're going to get momentum in that, and you're going to build a great solid foundation. But right now, it's about recognizing where your pitfalls are, where your weaknesses are, putting them down on paper, and creating a process to deal with them. And that's what we're talking about. Creating a process that will control risk and your biases. Guys, this is where traders lose. Okay? I've already had, a bunch of comments come back from yesterday's class, and a bunch of people come back to me and say, Mike, man, were you talking about me? Are you using me as an example? The answer is no, man. It's like, because even when I first learned this stuff, it was me to the T as well. So every trader, really give or take, goes through the same process. The difference is the successful traders, it's just like everything else in life, they stick to it, and they actually create a process to deal with the issues. Okay, so you're not going to change yourself overnight. That's a process for a different course, right? That's a process maybe for Tony Robbins. I recommend him. That's a process completely different. But you're going to create some processes. You're going to put out these pitfalls that you have, and you're going to try to work on them every day. And remember, we're working each week. We're adding to our trading plan. It's going to be a living document. It's something that you are going to be constantly changing, constantly working on. And, it's going to be your edge over other traders. Now, what we're going to talk about, the whole thing, the whole focus today is on risk. Okay, and I love, if you haven't read Sun Tzu, you need to get the book and read it. And I got tons of quotes in here. We got a document at the end of this that actually I'm gonna put up for you that you can have. You can even you don't have to buy the book. You can download it. I heard it's free online in a PDF format. So this is a quote from Sun Tzu. Victorious warriors win first, then they go to war, while defeated warriors go to war first and then seek to win. I have this as one of my top belief systems, one of my top trading beliefs. I read this every single day. Okay? Think about it. Victorious warriors win first, then they go to war. Okay? The battle is won before you even step onto the trading floor. Defeated, unsuccessful traders go trade first and seek to gain from their trading. Okay? It's important distinction. Another quote is, he who wishes to fight must first count the cost. Okay? I can't tell you how many times people in life, they don't count the cost of doing something. What is the cost? That could be opportunity cost, that could be risk. There's a cost, trust me. Okay, so let's talk about risk. Risk is defined in financial terms as a chance that an outcome or investment, actual gains, will differ from an expected outcome or return. Shocker. So you're telling me that there's a chance I'm not going to make money. Okay? Now, I love the fact when people say, well, I hear people that aren't traders and I talk about risk at the dinner table or something. They're like, I don't have to deal with risk. And, I always have to laugh because, I don't care if you're trading or what you're doing in your life. Everybody deals with risk. Okay? I'm sorry, but if you drive down the road, right? What's separating you from the other side where the cars are coming the other way? A little painted yellow line, okay? Are you taking a risk driving down the road? I mean, how can you even go out the door if you don't want to take any risk? Okay, everyone is exposed to some level of risk every day. And everyone has biases and doesn't even think about this level of risk. And I tell you, one of my big pet peeves that really kills me is people are so, not thinking about this risk that I just talked about, that you see people texting and driving all the time. Okay. And so it just goes to show. I see people, I remember I used to go and drive, into the trading floor every day, looking at people. I mean, you'd see people driving down the road, eating a coffee, eating a bagel, drinking their coffee and reading a newspaper while they're driving. Incredible talent, but not something you should be doing while you're driving. So, idiots. So everybody's exposed to some level of risk every day. You can't walk away. You can't get away from risk. It's just like sales. People tell me, man, I'm afraid. I don't like sales. Well, if you don't like sales, then how do you live your life? Okay? You have kids? Okay? Well, if you're not selling to your kids, I guarantee the crack dealer on the corner is selling to your kids. So you can't get away from this stuff, right? You have to deal with it head on. So everyone is unique and has their own risk profile. Everyone does. No two people are alike, okay? But the key is, when we're talking about a risk profile, is, to be successful at something, you want to model successful people, okay? Well, successful people look at risk first in their life. They look at risk first. Okay, that's why this right here, risk, okay, and how you deal with risk, is why most people fail when they try to invest outside their comfort zone. Okay, so I'll give you an example. Have you ever had anybody that tries to invest in a development deal or invest in a some other type of deal, right? And because they know, hey, I got to be making I'm making good money, and I got my buddy that says he wants to go buy and buy these real estate properties and yada yada yada. Well, the problem is, successful people, what they do when somebody comes to them with an investment deal, they don't look at the gains possible. They look at the risk first. So you got to change your mindset. What is the risk? Now, I mentioned risk profile. Okay, what is a risk profile? Everyone has one. Okay, and the key is for you to identify what your risk profile is. Okay, and a risk profile it's simply a person's willingness and ability to withstand risk, okay, to withstand loss, okay, and the question is, okay, how much is too much? So, we're going to go through a process today to really hammer home on what is your risk profile, because it's important for you to understand, okay, what can you tolerate, what can't you tolerate from a loss and from a negative standpoint, and life is just like the stock market, right? Stocks just don't go all the way up. They kind of stair step. They go up, they pull back, they go up, they pull back, right? It's the same thing with everything else in our life. So the key is, in those pullbacks, okay, how much is too much. What gets the blood boiling? And we're going to get in that process. Now, to also be good at trading, you got to understand your relationship that you personally have with risk and reward. Okay, and you got to understand the relationship between risk and reward. It's a fundamental relationship. Okay, it's pretty simple. More reward typically equals more risk. Right? I see it all the time, man. I talk to some traders and they're like, man, I was going to go into this trade and, I was going into this deal and, I was going to make 50%, man. The target was just insane. It was a great trade, but it went against me and I lost my loss was incredible. I'm like, well, what do you expect? There's a fundamental laws out in nature when it comes to reward and risk. Nothing comes for free. Right? You can't get something for nothing. And if you are going for some massive rewards, then, the law of nature says you are taking massive risk. Okay? And there's no guarantee. Now, you as an investor, the beautiful thing is you have an opportunity to be rewarded for taking that risk. Right? And, but the risk to reward relationship needs to be in balance. Right? And when you talk about trading, I see traders all the time. I ask them, what's your risk to reward ratio? They're like, huh? Okay. Well, you know anything about R multiples? What's your R multiple ratio? Huh? Okay. Traders don't even know what their risk to reward ratio is because they don't even look and know when they get in a trade what the risk is. Okay? So how can you trade that way? You're trading blind, and I guarantee you may be successful for a little bit, but you will fail. Guaranteed. Very few guarantees I give you in this course, but I guarantee you're going to fail. Okay? It's a guarantee. I don't care. Take it to the bank. Okay? I'll bet you. The key is this. Okay? You don't get into a trade because you don't know if you're getting into a trade. Does it seem pretty smart to get in a trade to where you're risking $2 to make 10 cents? Is that in balance? Is that really a good risk to reward ratio? No. Okay? But a lot of traders are doing just that. They don't understand risk, and they don't understand the risk reward ratio. They don't understand this relationship in balance, and they don't even know going into a trade, okay, what their risk is. So it's important, we're going to hit upon that, as far as, understanding what that is and making sure that you're taking good trades. Because I'm telling you right now, there are good trades out there, okay? Really good, lower risk setups. You can make 120% a year. Not a problem if you have a good system. Now, again, the problem is most people, okay, are focused on potential gains or the story, okay? And they rarely look at what is the worst case scenario. This is why most people are poor investors, okay? They get caught up into the story and the potential gains. Why? Because they're having an emotional response, okay? We in our fund, we also do development deals. We also, we're building a 30-story condo up in St. Petersburg, Florida. We're doing some other, development deals. And we get investors all the time that we talk to. And the problem is I see it every day. People, you get successful people that are working a job, right? And they make good money and they know, man, I want to invest some money. I want to make it, right? And so what happens is, somebody comes to them with a deal, okay? And they're like, oh yeah, man, I want to invest in that. Yeah, because why? Because they have an emotional response to the gains that's being talked about. Matter of fact, they're not even listening to you half the time because they're sitting in their mind playing the movie of them sitting in their car, quitting their job. They're caught up in already spending the money that they're going to make in this investment. Okay, and how life-changing it's going to be. And they're like or they're really excited about, oh, I always want to be a real estate investor. Oh, I always want to be a stock investor. So they're excited in the story, right? And even though you may sit down and say, hey, there's risk here, they rarely look at what the worst case scenario is. And so when somebody like that comes in and tries to be a trader and you bring those beliefs into trading, well, that is a recipe for disaster, okay? So you need to flip the script, model what successful people do. Successful people in all areas of life always work from a risk basis first and inward, okay? They work on what is my risk, because the reason they have money, the reason they're successful is because they keep it, okay? So if anything, you get anything out of this course, you're going to get an understanding of how you really need to move forward when you're dealing with risk. Now, factors used to assess risk. You have security. And what I mean by security is, okay, if I'm analyzing a deal, is there any collateral? That's security. Okay? If there is collateral, then guess what? Your return, because we're talking about the risk to reward relationship, your return is going to be less. Okay? Then, you're going to look at historical outcomes. You're going to look at historical behaviors. What's the person that's doing this investment? What's their track record? What's their experiences? This type of investment, what is the historical behaviors? So if I'm investing in options, pulling it into trading, what is the historical behaviors of option? What's the relationship to stocks? What's the relationship to VIX? Right? You got to understand all this stuff to assess the risk properly. And then you got to look and see, is there any other benefits? Is there any benefits? Well, if you're investing in muni bonds, which is municipal bonds issued and backed and guaranteed by states, well, you have a benefit that you don't have in any other security. The benefit is your interest that you receive is tax-free, okay, especially if you live in the state that it's issued, okay? So that's a benefit. So you're going to get less, okay? And then you need to look at, okay, well, what's the standard deviations which measures volatility, right? And we'll get into that in a little bit. And then also you assess time horizons. If it's an investment that if you're investing in bonds and it's a 30-year bond where they're not going to pay you your principal back until 30 years versus a 6-month bond, well, obviously the 30-year person, because they're locking their money up more and the risk is greater, that the world's going to blow up, okay, then you're going to get a bigger return for investing in a longer time horizon. Now, to understand this relationship even more, okay, I kind of showed you on a little paradigm here as far as financial securities and the fundamental relationship to return. Now, the Fed funds rate, let's go over that. Fed funds rate, that's the Fed, okay? Treasury prints the money. Fed manages the monetary supply, okay? And so they issue what's called the Fed funds rate. It's the rate that banks, get charged, okay? So, right now, because we're in this black swan event, the Fed funds rate target is from 0 to 0.25%, okay? And I just throw it up there so you get a little comparison of what banks are being charged at the discount window. Okay, then you have, and you can trade in these if you wanted to, what's called overnight swaps. Overnight swaps are nothing more than banks lending money to banks overnight to cover liquidity issues. Okay, and I pulled out what has been historical recently. So overnight swaps about 0.5%. Okay, then you have money market rates. And if you remember when I was talking about money market rates is typically cash, right? People consider it to be cash, always priced at $1, and it's typically invested in securities. It's a mutual fund in the sense it's an investment company that invests in other securities that are typically safer securities like overnight swaps, treasuries, and alike. Okay, they have low or no risk. Okay, so that's if it's a really considered cash. I see stockbrokers all the time, financial consultants talking, hey, just drop it in a money market fund, man. You don't want to keep it in the bank. Well, you put it in the bank, man. The bank's going to charge you a fee, and you can get checks. I'll give you a credit card, and you have it in a money market, and then we can easily move it in and out of trades. Well, and I love it though when they tell their investors, hey, it's like cash. Well, when you say it's like cash, people think it's guaranteed. Well, back in 2007, I talked about when we had the financial crisis. Well, the money market values actually broke $1. Okay, which had never happened before. But again, Paulson and Bush and everybody came to the rescue, as we do nowadays. Nobody takes true risk anymore. So money markets, I guess they kind of are like cash. 6-month T-bill. That's the government borrowing money. Nobody's safer than the government because they control the printing presses. So it's backed and guaranteed by the government. 6 months, get yourself 0.12%. Whoopity-doo. Okay, Treasury bonds, which is guaranteed by the government, longer term dated bonds, is 1.4%. Now, municipal bonds, which are AAA rated, the safest you can get, so you take away the liquidity risk there, default risk. And with municipal bonds, because you get that added benefit of the tax break, well, they're at 1.7%, depending on the state and stuff like that. Corporate bonds, which are, again, AAA rated corporate bonds, a little bit more risk because now you're talking about you're backed off of the financials of the company. But AAA rated is considered safe, 3.2%. Okay, junk bonds, which are corporate bonds that are not considered, investment grade by rating agencies, are considered junk, paying 4.8%. And then you got the SPY, right? You invest in the SPY in the market. I pulled the SPY return over, I think it was the last 10, 15 years, averaged out about 10%. Okay, and then you got private equity and development deals. And when I talk about private equity, I'm typically talking about buying companies, taking them private, breaking them up. About 13.1%. So as the risk goes up, or the benefits, when we talk about everything we talked about in analyzing risk, you need to have that balance and be rewarded for your returns. Okay. Now, there's entities out there that measure this risk. When I was talking about default risk, right? Morningstar will be the rating agency. It's a private company that will define out the risk on certain mutual funds and ETFs. Okay. You have Moody's, Standard & Poor's, and Fitch's dealing with bonds. And then, you have financial analysts out there, which is, investment bankers that put out these analyst reports, upgrades, downgrades, they're supposed to be able to help you measure risk, but, I don't want to get into that right here. And then you got financial advisors at the bottom of the total pool. I'm talking about stockbrokers, financial advisors. And look, I have nothing against financial advisors, right? Just you don't want to be using them as your measure of how you're doing in the market, or be advising you on market decisions. Financial advisors, the only thing you need to know about financial advisors is if you go get hired by a Merrill Lynch, one of those firms, you're going to get about 4 to 5 weeks of training, right? And of those 5 weeks of training, 4.5 weeks are all sales training. Okay? Yeah, but Mike, you got to take the Series 7 and the Series 6 and the 63 and all that crap. You learn it through that. Bullshit. We all know those tests, right? Because I used to have a company that would teach continuing education for those tests. Half the stuff on those tests are wrong because the market, the laws and security regulations have changed. So be careful who you're taking your advice from, but they technically measure risk for their clients as well. And again, nothing against financial advisors, nothing against stockbrokers, right? A lot of my best friends are financial advisors and stockbrokers. You just got to understand as a client that, really they're asset gatherers. They're not fund managers, right? And that actually may be a good thing. So the whole thing is if you just want to hand your money over and they're just going to gather those assets, and typically now they're just trying to lock it up for it and have the funds, the investment banks, people really manage it in a separate investment account. So that's cool and it's good, and it's where probably the majority of people should be if they don't want to be a trader. All right, let's get into maybe different types of risk now. Okay, so there's different types of risk when you're analyzing securities that you got to look at. One of them is business risk. Okay, how sound is the company? Okay, the management. How sound is the business? Okay, is the business really a business going to be around? Because I can tell you this, in the 80s, if you invested in the vinyl record industry, well, you went out of business. because that business went away overnight. Okay, so we want to do the Peter Lynch method, and you kind of want to go through and see how sound is this business. Credit default risk. What's the chances of the company defaulting? Are they a financially sound company? And a lot of people, a lot of traders, they trade stocks in companies they don't know anything about or even looked at. So, are they a sound company? What about, is it country risk? Is there foreign exchange risk? Meaning, are you investing in ADRs? Are you investing in China stocks? There's a certain risk to investing in those type of stocks and investing in companies that are in China. And give you a perfect example recently, right? With Biden winning or, supposedly going to be the next president, the China stocks were in the beginning when it was in, it looked like it was going that way. China stocks were in play. Okay, but the problem is China doesn't exactly run their country the way we run our country, okay, with freedom of exchange. And so Jack Ma, which, is founder owner of Baba, was coming out with this really, incredibly oversubscribed IPO and he pissed off and said some negative stuff about, the president of China. And basically China stepped in and, used some bullshit excuse and canceled the IPO and sent Baba shares crushing. And then they came out 2 weeks later and sent new improved regulations that makes it harder for internet companies in China and make other companies that they're invested in more freely able to default on their debt. So we've seen good companies like JD and stuff like that, get hit. So you got to know stuff like that, right? And so you got some of that risk, and you got interest rate risk. Okay, we talked about it. Back in the 80s, a bunch of stockbrokers got sued because they were selling little old people to put their money into bond funds, and that's a secure form of retirement income. And so they did it when interest rates were pretty low, just like they are now. So if you're buying a bond fund now, you're crazy, right? Because if you buy a bond fund and rates start going up, it's an inverse relationship. What's going to happen to the prices of those bonds? They're going to go down. Okay, and so a bunch of people got sued because all of a sudden they're down 40%, 30% in their mutual fund, bond fund portfolio, and they're saying, "I thought you said this was risk-free." Okay, I'm in retirement, for crying out loud. So they didn't explain that properly. And then you got to look at liquidity risk. How easily is it to get in and out of securities and to transfer your ownership? And that's what liquidity risk is. Okay, now that we've kind of really talked about risk, what risk is itself, now let's get into what really you're concerned with as a trader, and that's risk management. Let's get into risk management. And again, nice wouldn't be a good slide unless I had a nice quote from Sun Tzu. Every battle is won before it's ever fought. Through meticulous planning and preparation before a conflict, a person should be able to get into a position such that victory is assured. And that, to me, my friends, is kind of the secret, even, from all those decades and years ago, when this was written. It's amazing, right? How, history kind of tells a story and it rhymes, and how these are universal beliefs that you can't get away from. Okay, just like a lawyer, okay, going to court, it's a show. The battle was won prior to going to court. You as a trader, you are going to have a profitable or not a profitable day before you even sit down in your chair. Okay, because it's going to be based off your planning, your preparation, and how you react in the plan you have to deal with your emotions and your pitfalls. Okay, so that's important to understand. It's the same thing when we're dealing in risk management. And I want to give you a little story example of what a typical trader does and deals with when they're trading. So I'm going to give you a story of Ben. Okay, Ben's a college student. And Ben, like many college students do, he heard many stories about, he was reading a book, he was talking to some buddies, and he heard these stories about the Tzu bandits, and he heard stories about the turtles, and he heard stories about Michael Milken, and whatever other trader you want to throw in there, that made, riches, that were incredible, and how, the Tzu bandits were making thousands of dollars a day just flipping in and out of stocks, right? So like any other would-be wannabe trader would do, he said, hey, this is awesome. I can do that, right? So what Ben does, he opens up a Robinhood account, right? He takes his bar mitzvah of money, which is about $25,000, puts it in there, and then he goes to his parents. He says, look, I just, this is what I'm doing on paper. I can do this. I can mimic it, but I need a little bit more cushion to be able to get enough shares. So he convinces his parents to give him $25,000. So now, armed with $50,000 sitting in a Robinhood account, right? He now qualifies for 4-to-1 leverage in his margin account, which means now he can take that $50,000 and now have $200,000 worth of buying power, okay? And, he estimated that, this is going to allow him to trade those higher priced stocks such as Tesla and Apple, right? He's going to get in and out and make some money, right? Okay, first day of trading, Ben buys 1,000 shares of Apple at 120, okay? And typically what happens, he was up $5,000. Right? Then the stock turns against him and quickly goes down $2,000. He's now down $2,000. So it's a $7,000 reversal. And Ben, confident in his wares, instead of cutting his losses, right? Ben buys another 1,000 shares to average down. If it was a good story, it was going up before, I'm getting it even cheaper. Right? So then what happens? Apple sells off another 6 points, and Ben now is down $20,000 or 40% of his account in less than 2 hours. And, Ben, unable to take the pain anymore of watching his stock drop, sells all of his shares at the very bottom of the move. And what happens is within 2 weeks, okay, Ben repeats this process and has lost all of his $50,000. And on top of that, typically owes the broker another $3,000 to $5,000 because they let him go on margin and he got out and he owes the brokerage firm money. Okay. See, if Ben had understood and sat through this freaking class first and understood risk control, his chances of success would have increased dramatically, okay? See, the most common mistake that beginner traders make is that they ignore risk control, okay? Risk control is the foundation for survival of all traders. Successful trading is developed over time by winning consistently and conserving capital. But most traders, they ignore it. I even see experienced people, man, they go in trades, they're just hitting the button, right? Because we got these hotkeys, and you can hit these hotkeys now and get in a trade in a nano of a second and sweep in, and you have no idea. You just know the stock's going up. You have no idea what you're risking or how many shares you should be in, because how can you? The hotkeys are pre-programmed. I'm sweeping with 1,000 shares, so you're buying the same amount of shares in a $5 stock that you are in maybe a $10 or $20 stock. No consideration for position sizing or even or risk. Right? And so, even traders today that I see, even good traders, they're not taking risk into consideration, and I guarantee you're going to eventually fail, blow your account out. Traders must be comfortable first with the worst case scenario before they even consider to trade. Okay? Losses are inevitable and will occur. I hate to tell you, you're going to have losses, man. Losses, another guarantee I'm going to give you is you're going to have losses, okay? You must come to terms with losses because traders typically get comfortable, okay, with position sizes that go way past their risk threshold because they don't know what their risk threshold is. You know, I see traders that have, you know, a $200,000 account, and I ask how much stock, how much money of that account they have in this position, and they say, well, 200, or worse yet, 300, right? Because they're in margin, and it just shakes. I just shake my head, right? It's just, you know, that money. You know, a fool is going to be parted with their money. Okay, and so what we got to do first here is we got to start really understanding risk at its core as far as it relates to trading. You got to understand your risk tolerance. Okay, risk tolerance is determined by a couple of factors. One is your investment goal and time horizon, your past experiences, and of course your current financial situation. And then there's the fear factor, right? Fear basically equals risk and a risk aversion, and we're going to get into that in a little bit. So understand risk. You need to understand that the difference between actual risk, what we're actually talking about, the risk itself, versus the reaction of the risk. Okay, the risk at its core is unemotional. Okay, it's subjective based on assumptions and experiences, but risk at its core is not an emotional thing. Okay, it's a fundamental thing, okay, that has been predetermined and has been predetermined by your trading strategy and your trading plan. Has nothing typically to do with money. Trades are not about, you're not trading, remember, to make money. So when you put your plan together, when you sit down to trade, you don't have your P&L up because the P&L is a result of how you traded. It has nothing to do and has no part of the process of trading. So you are analyzing trades based off of your strategy that we're going to go over next couple of weeks, your edge that you have, your competitive edge, and based off your rules and your trading plan. So risk at its core is not based off of money. It's not based off of emotions. It's more fundamental in nature. Now, the reaction to risk is completely the opposite. Reaction to risk is a 100% emotional response basis, okay? And where do you get these emotions? Well, at the core of it is fear, okay? Fear. Think about it, man. You start seeing, you know, I've seen people trade and, you know, they're losing money and they're constantly losing, and they get into this situation where they just, you know, they don't, they're so emotional about it, man, and they are running, a lot of stuff's running through their heads, right? And so when you get emotional about it, you know, they're thinking, oh, I'm gonna have to quit trading, I'm gonna have to do, they throw all kind of stuff in there, right? We always overreact, right? And fear makes us do that. The fear of the unknown, the fear of, you know, I didn't follow my trading plan. And it's an emotional experience. Your reaction to risk is based off emotions. It's based off past experiences, and it's based upon your relationship you have to fear and money. And we talked about it yesterday. You need to know your relationship that you have to money. So you also need to know the relationship that you have to your beliefs. Okay, you need to understand this. It's so important if you're going to understand fear. So, you know, understanding fear is understanding what is your risk threshold, okay? And you must, write this down, must know what your risk threshold is, okay? Because it's the maximum level that you can go in the red before your emotions take over. It's the threshold at which the switch flips in your head and that you're going to sell or get to the point of creating damage in a trade that might ultimately be the best trade you ever took. Okay? And it's the reason the majority of people are pretty darn good at selling at market bottoms, and you know, it's based off of their belief. Now, how do you get this risk threshold? Okay? It's very simple. You got to ask yourself questions. Okay? Now, we're going to go through this right now, okay? Because I want you guys to get what is your risk threshold. Here's why risk threshold is so important. Okay, we talked about it. Everybody, we haven't gotten into it yet, but we're going to get into stop losses, Okay, everybody pretty much has heard the mantra, you got to have a stop loss, got to have a stop loss, got to have a stop loss, right? But they don't understand what that means. Okay, it's been said so much that they really don't understand truly what we're talking about when we talk about stop loss. Okay, so the important philosophy you got to have is that when you analyze a trade, okay, money has nothing to do with it. It's based off of your strategies, setup, and rules. It's based off the trading plan that we're going to help you put together over the next 2 weeks, okay? And so what happens is your risk, okay, where that stock can go down is based upon a technical level or a fundamental level, okay? And so, for the trade to truly work, you got to allow the trade to have breathing room. And so what happens is you don't understand position sizing yet. So if you go in with too many shares and you don't know your risk threshold, all of a sudden your stock, because it never goes straight up, right? The majority of the time, about 80% of the time, you're going to be in the red of a trade, okay? It'd be great if every trade you get in, man, you just green right away and off you go. But no, you're going to go red in a trade. Okay, because stocks, they stair step if they're going to go up. They stair step down. That's where we get bull flags and bear flags from, right? When we go into charts. So the key is there's a great chance in your trade you are going to be in the red. Okay, the key is what a lot of traders do. They allow emotion first to come into their psyche and into the decision-making process. And so they automatically, when they see the stock go down, they think, you know what? I'm wrong on this. I'm going to get out now because you know what? That way I'm going to save myself a couple $100 or a couple $1,000 by instead of allowing it to go down on my stop loss. That's the thought process they have, right? And so what happens is they get out of a trade, or instead of, they could have what we call a break of the risk threshold. And so what happens is when your stock goes down because you didn't understand your risk threshold and you didn't understand how to get into max size, what the true amount of shares you should have bought based on your risk and your stop loss and your threshold. So what happens is now all of a sudden you get in your trade and your stock's down $250, right? And let's say your risk threshold to really send off the bells and alarms is $100. Well, you're in this trade and you're sweating. Next thing you know, you're really stressing. You don't even know it, but you're tense, your muscles are tense, you're freaking out inside, and you're like, you know what, trade, and you're starting to get this mental buildup. And I don't know if you ever had this happen, but this is what happened to you. And then all of a sudden you're like, you know what, I got to get out of this stock. And because what happened was you broke through your risk threshold and you sell before it has a chance to breathe, because you have a system in place. We're going to teach you, okay, how to backtest your system. We're going to teach you how to get your expectancy level, and by the time you're done with this course, you're going to know and have the confidence to know, hey, I got to let my trades breathe, okay, because it's all based off my rules and my system. So what you got to know is, what is my risk threshold? So what I want you to do, we're going to do a little bit of it now, but what I really want you to do is kind of go through this process, okay? Go through this process later when you can sit in a quiet place, no one can interrupt you. I want you to be comfortable. I want you to be relaxed. And what I want you to do, all right, so you should be sitting up with your back, straight and good posture, okay? Feet, solid to the ground, like you're rooted to the floor as far as the tree is concerned. You're in a peak state, right? Calm state, no stresses. You're not thinking about anything else. And then we're going to start the process of visualization. So you want to start taking some deep diaphragmatic breaths. And you want to make sure, you're taking diaphragmatic breath. If you breathe in, your belly, put your hand on your belly, it should be expanding out when you breathe in. Okay, that means you're breathing deep correctly from your diaphragm, right? Take those deep breaths. Then I want you to close your eyes, okay? And I want you to start putting a picture in your head, okay? A picture in your head of yourself sitting down trading, okay? picture you buying 1,000 shares of Apple. Okay, I don't care that you just say that, Mike, you went through this course, you got the, we gave you a job, we gave you, $5 million of our money, you're trading, and you bought 1,000 shares of Apple. Okay, now picture, you look at your P&L on your screen and you're up, you're green. Now picture what your emotions are. What's your state of mind? Really get into it. Picture seeing you in 1,000 shares of Apple and see on the screen that you're up, right? Let's say you're up $550. Now all of a sudden you see it go up to $1,000. You're up $1,000. How do you feel? What's your mood? Are you still relaxed? Are you still, what's your muscles like? Go through this process. Okay, now, keep on visualizing it. Watch the trade, watch the chart, right? The stock's going up and down. Okay, now all of a sudden, okay, Apple is only up $200. Okay, think how you feel. Be in this, be immersed in it. How do you feel? Apple's only up $200. Uh-oh, the market's starting to pull back. You notice on your other screen, SPY's starting to pull back. Apple now is red. Apple's red $100. Okay, well, think about it. How do you feel? Apple's red $100. Do you feel any differently? Okay, yeah, maybe you don't have you don't have the elation you might have had before, but are you really nervous? Put yourself there. Are you nervous? Right? And then, well, what about if Apple's down $200? And keep on increasing that number until you get and you can truly visualize what that area is, that level that really starts to elicit an emotional response. Okay? Everybody has this level. You need to find this level, because when we go over tomorrow and the end of today and we start talking about how to position size your account, how to put shares on, how to set stop losses, how many shares to buy. Okay, when we truly get into the meat and potatoes, if you don't know your risk threshold, it's all for naught. Okay, because you're not going to give your trading enough room and you're not going to follow your rules. You don't need something that's going to trigger an emotional response out of you. So sit down, it's as simple as that visualization. Just calm yourself and be in the moment. Visualize in your head. Visualize your exact setup. Go as much detail as possible and think, if the stock's down 100, how do you feel? If the stock's down 200. Now, the one thing I want to change is make it your money that you're trading, not our money. Okay? So make it your money. Make it a little bit more realistic. Make it your money, because that's where you're going to get the realistic response from. And matter of fact, don't make it just your money. Make it money that you borrowed from your parents. Make it money you borrow from your grandparents if they're still alive, okay? Somebody that you truly, truly, really care about, right? And don't want to lose their money, okay? Find out what that number is. Find out what that threshold is. And for some people, it's $100. For some people, man, it's $200. It's different for each person, right? And it's different based upon all the things we talked about up here. But the key is you need to know what that risk threshold is for you, okay? And what's going to elicit that emotional response. And you'll know, okay? And if you've traded before, think back. You can use that as an example too. Think back when you traded before. What's the number that typically gets you to start really the shallow breathing, right? Because most people, when they're sitting at their screen, the way to tell you have an emotional trigger, right, and you have an emotional response, it doesn't have to just be losing money, is that you start to change the way you're using your muscles. They may be getting tighter. Your focus may be getting narrower. You may be breathing shallow. You may not be breathing at all, for crying out loud. I've seen people on the trading floor, got to hit them on the back because they're not breathing, for crying out loud. Trading may not be for you, see, you got to just be aware, right? Awareness. Okay, you got to be aware of all these different components. If you have a heart monitor, everybody has an Apple Watch now. It has a heart rate monitor on it. Measure your heart rate. See what your heart rate was. Okay, did your heart rate? A lot of people have their heart rate go up and they really elicit some responses and they don't even know they're doing it. I spent a lot of time on this because it's important. Hopefully I hammered home that you understand, because we don't need you having these triggers, these emotional responses automatically. You got enough crap that you got to fight. You got enough pitfalls we talked about yesterday. We got enough position sizing. You got enough to deal with than to have to deal with a poorly positioned position sizing formula that's in your trading system and a poorly designed system, because you don't want to have these emotional triggers. Okay, because here's the key. Okay, it only takes how many? One large loss can set you back a year. Okay, I don't know how many of you want to go and get into a business and then screw something up to where your screw up cost you a whole year of making money. Think about that. Now, all my kids have pretty much, I've had them in sports all their life, right? And, my girls, they were really good at soccer. The boys, same thing, football, baseball, got them into competitive sports. And so the only thing I can equate this to is, both my daughters in soccer were goalies, okay? See, when you're a competitive athlete, right, and you're on the soccer pitch, well, if you're a field player, if you make a mistake, okay, it doesn't always cost your team, right? But guess what? If you're a goalie and you make a mistake, you immediately know it, because ball goes in the back of the net and it costs your team dearly, and everybody's staring at you saying, what in the world did you just do? Okay? And so, being a parent of a kid that actually, was a goalie is just insane. Don't do it. Wouldn't recommend to anybody. But anyhow, the point is, that's the only thing I can equate it to, right? Because, one mistake can really set your team back. Well, here in trading, it's the same thing. One large loss, you may have to wait a whole year, and who's going to stick that out? Okay, so I want to hammer this home that the whole purpose is for you to learn from our mistakes. The reason we're creating this foundation, the way we're doing this, is so that you learn, okay, repetition, learn that you don't have that one large loss. Because I hate to say it, you can do 90% of what I went through, and that 10% that you just, because you're a human being, and you can still have that large loss and kill your trading career, at least set it back pretty dramatically. I'll give you an example. Let's say that, and we're going to get in trade metrics later, but let's say that, you have set a 2% stop loss. Right? And, the trade that you're going into, your target is a 4% return. And your trading system has a 55% win rate, and you have a 1.3% expectancy, which means on average you make 1.3% a trade. Great trade system. Okay, you got $100,000. Okay, now you're buying Apple. You buy Apple at 120. You got a stop loss at $2.50. You put it in. Okay, that stop loss is 117.50. Which, what does that mean? Do I have to say it? It means that if your stock goes down to 117.5, okay, $2.50, what are you doing? Holding? I see people out there saying, I'm holding, man. It's going to go back up. No, you're selling, okay? And you're not going to have hindsight bias and see it go back up to maybe 130 and say, see, Mike is an idiot. I should never listen. There's people, stop loss people, they're dumb. No. That's what we call hindsight bias, and be my guest, but I won't see you on the trading pitch anytime soon. Okay, so let's say that the price hits your stop loss in this example, and you decide not to sell. So and this is not just a process that you automatically typically come out and say, I'm not selling 117.50. Screw that. No, it's typically the stock. What will happen is it'll go down to 117.50, then it'll go, or 117.52. It teases you, right? And then it goes back up to 118, and you're like, "See, I almost hit that button, man. I'm so glad I didn't hit it." So they tease you, right? And then what happens? It starts coming down again. You start sweating again. You're like, damn, it's getting down here again. But that's all right. Went back up. Mike said, it's stair-step approach. You're going to be in the red, no problem, right? Then all of a sudden, it hits 117.42. It goes right through. It jumped from 117.55 to 42. Didn't even hit 50, right? And so you're looking at that saying, oh, well, wait a minute. I think it's going to go back up, right? And you're just sitting on the edge of your seat. Picture yourself. Have you ever done this? You're sitting up now in your seat, like you're watching some, like the last second of a game, right? And you're like at the edge of your seat, seeing what the heck's going on with this stock, right? So now you're tense, you're really into it, and then it goes back up to 117.60, and you're like, whew, wow, come on, keep on going. I even hear people shouting. I feel like I'm at a horse race, right? People are yelling at their stock, get up, get up, get up. Go, 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 right? And I'm like, what the hell? I thought we're supposed to be controlling our emotions, right? And then it goes down to 117.38. And you're like, don't worry, man, it's coming back up. It's coming back up. I know it, right? And then you start going through charts. And you start pulling up other indicators. You start looking at other stocks. What you're doing now is you're looking for confirmation bias. We talked about that yesterday. So you're trying to confirm your shitty thinking. Okay, now all of a sudden the thing drops below 117 and drops to 116.85, and you're like, oh, well, I'm too far in a loss now. You're in what I call the hope stage, right? Apple's a good stock, man. I got the watches, I got the phone, right? They got new computer chips, man. It's gonna be back at 120. This is what we call allowing your trade to become an investment. And no, I'm not talking about anybody, okay? So this is what we call allowing a trade to become an investment, because now you hold overnight. It's going to gap up tomorrow. I know it. Well, you get up, you get your coffee, and you get up later than you would because you don't want to look at it, right? You're too nervous. And then you get to the opening bell, and your heart sinks through, the bottom of your through the bottom of you, just goes right out of you. Apple's at $85. They came out with some kind of product delay. It temporarily is shooting down, and you are so fraught that you hit the sell button. Okay. Not even realizing that, you are selling at the bottom, right? Too far, too fast, okay? You already blew through your stop loss, and you have now a 29% loss. So now your $100,000 is sitting at $79,000. I use this example because I don't want to make it too big of a loss, right? So I use this example for a reason. So now what you're realizing, in order to get back to break even, you need to really make some serious money. You gotta make 41%, right? And following your trade metrics above, you are gonna spend the next 43 days, 43, to climb your way back just to get to break even, because you couldn't hit the sell button at 117.50. Okay, so the next 43 days, doesn't matter what you make, your metrics tell you that if you don't make any more stupid mistakes, you're going to get, you're not going to be able to make any profit, because you're just going to be recouping those stupid losses. And this is an easy example. I'm not talking about examples when your account is down 50% and you keep on dumping more money into it. Because the problem is when your account goes down and you have this loss, you now lose an asset, a portion of your asset that you were using to make money with. So now you got to make the money with less of a pool of money, and it becomes harder to make that money back. Okay, it becomes a lot harder. Don't do it. Okay, this is the typical example, and like I said, it doesn't happen. They tease you. Okay, it doesn't, and that's exactly how it happens, man. You're like, oh, it's coming back. You don't want to get into the hope train, because the hope train is a train that leads to a town called nowhere. Okay, and ruin. So we want to have a risk management plan so this doesn't happen to you. Okay, so what we're going to look at in this risk management plan that I'm going to talk about is we're going to look at the companies you trade, because people don't even look at risk. You know, I love it, man. And I went through some trading books, right? And even the really good trading books, they don't talk about risk as deep as it needs to go. You're going to get it as an in-depth analysis of risk that you're not going to see anywhere, man. And, you know, nobody talks about risk of the companies you're trading, okay? Nobody really talks about, you know, pricing risk, spread risk, liquidity risk, emotions and skill set risk, asset protection we're going to talk about, trade management, trade setups, and position sizing. So that's what we're going through the rest of this class here. So let's dive into it. Risk management in the companies you trade. Nobody I don't see out there talks about this or even thinks about it. Okay? I see these strategies of these investors. I see, you know, and I don't name names, a really good trader that trades these momentum plays in the pre-market and when the market opens, these low float plays, and he puts his results online. You can see them. And I see these traders and I just look at them, and it's a really good system, by the way. And he's a great trader and he's a great educator and teacher. The problem is I see these traders and they have no clue what they're getting themselves into. And I never hear anybody talk about, well, what about the risk of the companies you're actually trading? Because a lot of those, 90% of those companies that he's trading is bullshit companies. Remember the Wolf of Wall Street, right? Well, you see that picture there? That's the radar company. He was selling shares off the pink sheets, okay? It's in somebody's garage, okay? So, you know, this is an unrecognized risk that you will not find anywhere, okay, that you got to take in consideration, because people don't realize that you could be trading a company. When you trade a stock, we talk about what securities you're going to trade. Well, those stocks, the reason we went through that, you know, repetition of the easy stuff, right, that people skip, we did it for a reason, because those stocks are actually companies that are being run and are in business. And those companies can occasionally go bankrupt, and those companies can occasionally be delisted. Okay, that's why we talked about, you know, in last week we talked about indices and what it takes to be listed and what they're all about, right? Secondary market. You know, what happens if a company gets delisted? We talked, and there's another educator out there that talks about nothing but penny stocks, and he's a really good educator. Love him. Okay, but penny stocks are low float stocks that are manipulated, that typically they probably have their business in a freaking garage or in their mother's basement. Okay, and they're going up because they're being manipulated. And, you know, the SEC doesn't do anything about this, but, you know, I'll let you go to that guy's page because he really is beating the drum on that, and he does a good job of it. Okay, but you need to understand the stocks that you're trading are pieces of shit, not worth anything, right? And, you know, you're trading these low volume companies that have large point spreads possibly. I get traders all the time. I love it. Mike, look at this stock for me. Okay, I pull up the chart, always looking for a stock. You know, that's why I belong to a bunch of different chat groups and everything. You never know where you're going to get an idea. Okay, but we're going to talk about, you don't trade other people's ideas. Okay, it's got to go through your own filter. But hey, like I said, these education services, you know, the two guys I talked about, they have great services and they give you great ideas, right? And they're great technical ideas. Okay, so, you know, I'm not bashing on them. But the key is, you know, some of these companies, you know, they're bullshit companies. And so, you know, I get traders all the time. Mike, look at this stock. I'm going to trade this stock today. And I look at it, and it's got these little dashes in it. What does a little dash, when you look at a chart, and it's a candlestick chart, and you see a little dash on it, and then a little bar, and then dash and bar, and a bunch of dashes in a bar. What's the dashes mean? That it didn't trade that minute. Okay? Let me ask you a question. If you're investing, can you invest in companies like that? Absolutely. But if your business is day trading, do you want to be looking at charts where there's little dashes, which means there's no volume going on? No. Okay? Because a lot of times, not all the time, a lot of times, you got these companies, they may have wide point spreads. Okay? And in the age of hotkeys, okay, I want to bring this up because this is important. People don't think about this. Okay, be careful. You have this hotkey that you can get in, and typically they set their hotkeys at plus or minus 3 cents on the bid or ask, right? So make sure that, you know, a fast-moving stock you get in, right? Well, the hotkeys, people are hitting hotkeys on stocks that have a huge spread, and they look at their P&L, and they're automatically down on the very first second that they got in, $200. And they're like, Mike, why am I down? I was like, shit, I'm down $200. And I have to admit, I've done that. Okay? So I'm not going out and not making fun of people. I've gone through this process. I still do that. I did that the other day, actually. You know, I hit a hotkey, got in 1,000 shares, and I was like down $600, and automatically, I was like, whoa, you know, what am I doing here? You know, that's usually Nick gets in these you know, wild swings and shit like that, not me. And I'm like, wow, you know, about fell out of my chair. Because it had a company had a wide spread, and so I got hit on the ask. You know, typically a little tip: if you see a company has a wider spread, and we trade Beyond Meat a lot, right? And some of these higher price stocks can have wider spreads, and so I wouldn't recommend going in. Though sometimes you do have to use hotkeys if it's really a fast-moving trade, right? But sometimes they have a wider spread, and you want to get a better entry by hitting in between the spread, and you can do that. Okay, and typically you'll get hit. Okay, but you got to be careful. I don't know if you ever read the book. You should have. It was a homework assignment for last week, which was Reminiscence of a Stock Operator. Okay, if you read that, it's really an unauthorized biography of the famous trader Jesse Livermore, and a lot of the techniques and stuff and the philosophies that he used and described in that book can be used today. Okay. Now, when I first started trading, level 2 was you can get really a good advantage analyzing level 2. You still get an advantage, but it's not like it used to be, right? Well, an even better recognized method to do is when we teach you scaling into positions and not putting all your shares on at once. Well, try putting in an order at the lower end of the range, okay? And then try putting in an order at the higher end of the range. If the order in the lower end of the range gets hit, there's a good chance that there's a seller in there and that stock's going to go down, okay? Because they're reaching down and grabbing it. Okay, in a stock that's going to get ready to go up, and a stock where there's buyers, they're not going to go down and hit that order, right? They're going to go. You're going to have the higher order hit. So how your order is taken, I see, beginner traders and even experienced traders all the time putting in these orders. They're looking to get into a stock, and it's flying high, and they're putting orders in way down here, lower down towards the bid, or even lower than the bid, thinking, oh, I'm going to get in at a really good price, and really. If you really analyze what they're doing, because it's not the way you want a stock to act for a stock you're trying to get into a fast-moving momentum trade, you shouldn't be getting hit down there, because then it invalidates the trade, okay? It invalidates the whole supply-demand thesis, and so what happens is really what those traders are typically doing is they're self-sabotaging. They're afraid to get into the stock, and so they put in a lower order, and they don't get it hit, and they're like, oh, I tried to get in, averted that disaster. Okay, so be careful. Make sure you're not self-sabotaging yourself. Okay, but be careful if you're using your hotkeys and you're not looking at the spreads of the companies you're hotkeying in. You can really put yourself at a disadvantage with a bad execution. Now, you also, getting back to looking at the risk of companies you're trading, you also can have stocks in the middle of the trade day stop trading. It's called being halted. Okay, now a lot of traders I see get excited by this. And I've been there. I've traded momentum too. I get occasionally excited about halted stocks and try to position myself in. If you understand a halted stock and a momentum stock that's up maybe 700%, like Kodak or one of those stories, and it's the first halt. Trying to get in before the halt is like trying to fit 20 fat people through a tiny midget door. Okay, everybody's trying at the last second because they know the halt levels by now. They got these software programs, and they're all trying to get their orders hit so they can get in for the halt level. But what's funny is, and what a lot of these traders don't realize, and I've done the same thing, but what a lot of these traders don't realize is that, that stock could halt and never open up again. Nobody thinks about that. We've seen it all the time. Nobody thinks about that. Let me show you examples. So in case you don't believe me, Luckin Coffee was a darling of Wall Street, right? A lot of big firms, big traders trading Luckin Coffee, right? Really strong stock, popular stock. Here's the daily chart. Luckin Coffee, okay, was trading at $51.38 back at the beginning of the year, and then fell back. And let me kind of pull up the intraday chart here. Got halted on 4.7 and didn't open up again until May 20th. So about 2 months it was halted. When it was halted at $4.40, and it opened up at $2.14. So you didn't even have a chance to sell your shares. Okay, so let's go to another one. Zoom. Okay, now I'm not talking. If you thought of Zoom, you're like, Mike, Zoom's like up at $500, man, $400, man. What do you mean Zoom halted? What do you mean Zoom at $10? I'm talking about Zoom Technologies. Okay, traders, a lot of traders, look, some traders aren't the brightest bulbs in the pack. Okay, really, there's not many smart people out there. So you get, taking money from people is not that hard when you're trying to trade, right? And so you had people that drove up Zoom Technologies, which had the ticker ZOOM, traded it up, drove it up. I want you to hear this. Drove it up from $10 a share to $60 a share. Okay, why? Because they thought they were trading Zoom, which has a ticker symbol of ZM. I kid you not. So, going back to that chart, they drove it up to 60. It halted, I believe, in this past March. And guess what? It's still halted. Okay? It's still halted. Works. Again, another company, one of these companies went from a penny stock to $15 in one day, right? Everybody, it's halted a bunch of times in there, and so everybody's waiting for it to halt to happen again. Well, look at Works here on 4/21, got halted around $6 a share, didn't open up for 3.5 months, and it opened up at 2. Okay. Last one, CYPE. Okay. Another one of those. Now this is a really penny stock. Thanks. Nick put these charts together for me, and I love this, man. This is one of those dog shit stocks that's probably in someone's backyard, right? It's probably in somebody's doghouse, for crying out loud. I mean, truly a shit stock. And this stock, went all the way from pennies. I mean, you gotta love a stock if you look at the price axis, and it actually traded at 0.00001. Okay, I'm sorry, but call me old-fashioned, but if you can't even trade at a penny, I don't know I should be trading that stock, right? Well, it went all the way up to 0.6, right? Traded on, halted at a quarter, 0.25, and opened up later way down here. So next time you're one of those fat people trying to squeeze through the midget door to get in on a halt, keep these charts in the back of your mind as a warning, okay, that sometimes these stocks halt and never open up, and get rid of the fact that you probably have a massive loss when they reopen. All those stocks had massive losses, but think about it. The one stock's been halted since March, which means you don't have that capital to trade. Okay? You don't have that capital to trade. So when you're trading this, think about the risk of the stock. Really important. So now let's talk about risk management as far as emotions and skill set. Okay? The emotion of losing money, we talked about it. You got to know your threshold. Okay? If you don't know it, figure it out tonight. And you got to ask yourself a question. Can I afford to lose all of the money in my account? Seriously, ask yourself that question. Can you afford to lose all the money in your account? Because most successful traders are comfortable going in knowing if they lost every penny, they would be fine. Okay? At least from an emotional standpoint. Because you got to know the emotional pitfalls, right, of trading. And they're magnified to when you have losses. And they're especially magnified when you bring a bunch of baggage to the trading floor with you. So if you're trying to trade to make money to live off of because you don't have enough money to survive, you shouldn't be trading. Okay. Remember I talked about yesterday that big bag of crap you carry around, from your inner story, all this stuff that you're carrying around, like, Ebenezer Scrooge, like a bunch of chains. I told you to leave it at the door. Okay. Be free. Let go of all that stuff. Forgive yourself. Leave all that crap behind. Same thing, man. You can't bring the stress of having to, pay the rent and not getting kicked out from your house to be successfully trading, right? Because then you're going to have to look at the P&L. You're going to be trading for money. You're not going to be trading for the benefit of just putting on one good trade, and you're not going to be successful. Don't bring that pressure, okay? Wait until you get into a little bit better position. Self-discipline is required, right, to take that loss. Hope is the one virtue that you cannot afford to have. Hope will kill you. Okay? The hope cannot, that word can't even enter in your brain. Just like, Tony Robbins talks about transformational vocabulary. I don't really ever get depressed because you know what? I don't have the word depression in my vocabulary. Okay, and so I don't feel those emotions. It's the same thing. I don't even want hope. Erase it. Do whatever you got to do. Go out one night, drink like a fifth of Jack or whatever. I'm just joking. And whatever you got to do to kill the brain cells, to get rid of hope and wash it right out. We don't want anybody having any hope in here because hope will kill you. Okay, you're not going to sell because you're going to hope it's going to go back up. Okay. And then, we're going to teach you here about position sizing, and it's really going to be more in tomorrow's class. But large positions, typically new traders, they come in with, the big thing swinging, and, they go into way too large of positions. Large positions go hand in hand with large emotions. Okay. Don't do it. And then also, as far as when we're talking risk management, make sure that you're not, and you're going to write this down, your risk management plan, you're not vengeance trading. Because vengeance trading, I did that actually. I caught myself doing that 2 weeks ago when I was trading Beyond Meat. I lost money on Beyond Meat, traded it poorly. I traded that thing 6 or 7 times over the next 30 to 40 minutes to make that money back, and I realized I was vengeance trading. I was pissed off at Beyond Meat, and I let my emotions take over. So somebody has done it for a while and has a good handle on the emotions in the trading realm, you're still going to slip back and you're still going to have those issues, okay? So vengeance trading, don't let it pop up, okay? Because it will. Now, when we're talking about risk management in the form of protecting your money that you're trading, okay, what you're going to do, and we're going to really hammer this home tomorrow, is you're going to maximize your losses that you can incur, okay? You're going to have, and it's typically 1%, whatever it is we decide on, or you decide on, you're going to have a max loss per trade, per day, and per month. And if you hit those losses, you are done. So if you hit that loss in a trade, you're done. You're out. If you hit that loss for the day, you're done. You're not trading anymore. And if day number 2 of the month, you hit your loss for the month, you're done. Take the rest of the month off. Okay, because obviously you got some issues that you got to work through, and we don't want you to blow your account up. So these are what we call governors that is every successful trader has, and if you go to work at a prop firm, you're going to have it there. You come work for us, you're going to have it automatically as well. And, they're not going to increase those numbers and give you more leeway until you prove that you got risk management and risk control under your belt. Okay, so they're not going to let you blow out the account. So the first 3 months that you go live after this course, I want you to understand something. You are trading to learn, not to make money. So if you're expecting to make money the first 3 months that you get out of trading, I'm sorry, but you got unrealistic expectations. Okay, you're still in the learning field. Now, think about it. If you want to become a doctor, okay, you can't just expect to go to school, right? And, even you have the best doctor in the world trying to, teach you this stuff, and then come right out of doctor school and go, be a doctor and make tons of money. No. Doctors, because it's so important what they do, they got to go through what's called residency, right? And it's where they kind of are in a job, they're out of school, but they're learning on the job. It's the same thing in trading. Okay, give yourself at least 3 months of residency to learn how to trade. Do not expect to be making consistent profitable money the first 3 months, because you're going to frustrate yourself, and it's an unrealistic expectation. If you guys didn't hear the very first class, go back and re-listen to it, right? Because Nick and Tyler went through their experiences when they first started trading, right? And they did a great job. And even Nick said, look, a lot of firms, a lot of people don't expect to be profitable until a year that you've been trading. Okay, there's great benefit, great rewards, and you got to make sure that you are giving yourself the proper setup. You're realistic. Okay, now success. A couple things we're going to get into now is risk management towards trade management. Okay, and successful traders typically earn about 80% of their profits from 20% of their trades. Okay. So when you talk about successful traders need to let your profits run and cut your losses, this shows it right here. So if you're getting 8% of your profits from 20% of your trades and you're seeing that same metric, then guess what? Okay, you can be wrong more than you're right as long as you follow that philosophy. And so we're going to take predicting the market out of your hands. When you're done putting your plan together, you're not going to have to worry if you're predicting the market, because you have a plan that's rock solid. So typically successful traders will constantly sell positions in the same trade for small losses and then re-enter when momentum finally turns in their favor. Sometimes you may have to go into a trade and it may go against you and get out. Go into a trade, goes against you, get out. Going again and gets out. And then that final time you see the momentum finally turns and you go into the trade again and you get the win. Okay, so if you have a good system and you have checked emotions at the door, you can do this and you can be successful at it. I see it all the time. I talk to traders, they go over their trades, right? And they show me, man, I got in this trade, it kind of faked me out here, went above VWAP, and then it came back down, it got out for a loss. And I said, yeah, but look here. It actually was a good trade. If you would have, did you get back in? Well, no, I lost money when I'm done with that stop. Okay, well, no. That's not what successful traders do, right? The market's not like that. You may have to get in and out of position several times, right? So, okay, you got in, you got out for hopefully a small loss, right? Yeah, and then you missed the trade of the decade right there on the back end because it went through and it finally got that momentum, finally got the buying volume behind it, and it finally pushed through. So you were correct in the thesis, you just weren't correct in the timing, okay? Just understand that. Now, stop losses should not be, should not. Yeah, stop losses should now be ingrained into your psyche. They are a foundation of every trading plan. Okay, it's the key thing that you need to understand in risk management. And stop losses are based off your trade plan. They're independent from money. They're based off a technical level. Okay, and each trade that you get in should have a thesis and should be based on your competitive edge and your strategy. Only time you're allowed to get out of your stop loss, okay, before is if something fundamentally in character has changed and is part of your rule. Okay, and you are now, because it's part of your system, it's built in, you now may be getting out for a loss, or on the target side, you may be getting out for a profit. We talk about too far, too fast a lot, right? Because stocks typically got to have some pacing. Now, that doesn't always work, but again, it's about putting the odds in your favor. So there are going to be some exceptions where you get out, but it's going to be rules-based when you get out. So again, I don't know if I got to have it tattooed on the front of your head. You never, ever, 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 ever let a stock price go past your stop loss. Okay? You never, ever, ever allow a trade become an investment. if you did not have that established from the beginning as part of your thesis. Now, when we talk about stop losses, you got to be careful. The old adage and the old question is, do you place the order or do you not? Okay, that's the question. When we talk about stop losses, so Mike, okay, I understand. I got it, based off of my trading strategy. I got to know where my risk is, stop losses where the trade thesis now is invalidated. You're wrong, okay, and so that's where you're getting out, okay. But the question is, when do I place those orders? How do I deal with stop losses? How do I execute stop losses? Okay, well, you got to be careful. I'm old school, okay, because I've been on the other side. Okay, and having been on the other side, worked at Lehman Brothers, I understand what the thought process is on the other side. So we went through specialists and market makers for a reason. We went through indices for a reason, and the process, so you can understand this stuff when we're talking about it. So market makers will, they have a book, and they're in the business of making a market in your stock. So a lot of times market makers, and I know you can put an order in and hide it, but yada, yada, yada. Okay, market makers will run stops. Okay, so my personal theory is, and I know this is dangerous, is that I don't personally put in stop losses unless I am walking away from my computer and I can't follow the stock, intensely, right? I'll put my stop in and do a stop limit, and I walk away, and I'm comfortable that it's in. Now, putting a stop in me is typically good for a lot of new traders because they can put it in and then just, I can put a bracket order in, and I can walk away and not think about it, and it takes emotion out. But remember, avoidance isn't a good way to deal with an issue. So a lot of that sounds like avoidance. You got to be careful. Now, you may be asking me, what do I mean by a stop run? Okay, well, the stuff we're going to teach you, the reason there's no Holy Grail is because it's all based off technical analysis, which is all bullshit, okay? It's all based off, everybody is learning the same stuff, which means everybody's looking at the same charts, everybody's drawing the same lines, everybody has the same levels. So don't you think that your good old market maker in Baba knows exactly where a lot of these stops are? I mean, he doesn't even have to look at his book, which, by the way, he has the inside information on, inside track on. He doesn't even have to look at his book to know where the stops are. Now, I know it may sound like I'm talking about manipulation. The SEC says that doesn't happen, and we weed all that shit out, yada, 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 yada. Okay? You know what I call. Okay? So you can look at this chart at Baba. Okay? Now, if you're looking at this chart, is this a bullish chart or a bearish chart? Okay, and we haven't gotten into charting, so it's not really fair to you. But if you're looking at this, right, you see the lines below the line, there's a good chance you can understand this is a bearish chart. So a lot of people are looking to come in and short Baba. Okay, well, now let's look at a wick out on Baba. Well, Baba drops from the open, so all the shorts looking good, right? And then what happens? They drive it up to a common technical indicator, which is this case, it's VWAP. They drive it up wicked above. Why? Because a lot of stops are at a break of VWAP. And then what do? They do the majority of the drop then. Okay? Because understand what the market maker is doing. The market maker has to take the opposite side of your trade. Okay, typically. They got to make a market in that stock. They got to hedge their positions, hedge their risk. And I know they make the difference, which is the spread. But, a lot of times if they see a bunch of orders on there, they're going to wick it up and they're going to sweep the stops and then they're going to run it down. And you're going to be one of those that, had your order in, it gets hit, and then next thing you know, bam, slam, bam, thank you, ma'am, you're out. And you come to your desk, you look, and Baba's down, down 10 points. You're like, what do you mean I'm out? What do you mean I got a loss? Okay? So, I don't want to see that happen. It can definitely happen to you. The other issue with leaving stop losses orders and leaving extraneous orders out there is, and I've seen this happen to experienced traders, is that you forget about the order. And you may actually get out of the trade a different way, right? And you still have that order out there. And the next thing you know, and not necessarily a stop loss order, but it may be just an order out there that sell. And next thing you get hit and you're in a position, and you didn't even know you're in a position because the order was out there. I'll use another one. Tesla, okay? This is Tesla the other day. Got added to the S&P. So this is a real example, recent example. Look at Tesla, right? This is a bullish chart, right? Bullish setup, okay? Well, let's see what happens with Tesla, okay? Well, look what they do to Tesla. Look at that little wick down. And so a lot of stop losses are sitting where? 485, right? That break right there. So, Tesla, wicks a whole bunch of people out. And then off they go. Right, and and they do it. You can see where the highlighted little patch is down. I'm sorry, 450. I said 485, but 450. So they wick you down, and then they hit the stops and they run out. And here it's double whammy for these stops here. The reason it's a double whammy is because Tesla, you got a whole number of 450, which is an important daily level, and you got VWAP right there. Man, that is just too sweet for the picking. There's a whole bunch of stops they're going to run right there before they run Tesla up to 500, which is a magnet, which is where we were looking for it to go. So, you got to be careful there. Target. Again, another chart, right? Another bullish setup, another chart from today. Wow, these are great, real life examples. Well, look here. Target, nice little trade. This is kind of setup that we use almost every day. Breaks the opening print on the downside, comes back up through VWAP. Is looking very bullish, nice long bar. We actually took that trade today on our floor. We got out because it was too quick on that big bar. Made a really good alpha and got done. But it was offering another trade setup on the VWAP hold, and they ran it up to 172. But before they did that, what did they do? Well, they broke that important daily level, right, at like 166.50. Broke the level, broke VWAP, hit the stops and ran them. Okay, so you got to be careful, and that's what I'm talking about, the stop run. So when you're talking about stop losses, they're important. The risk is by telling you not to put the orders in that you're not going to follow through, and now you're putting the decision into the hands where your emotions may take over. So in the beginning, as far as being a new trader, I pretty much would recommend putting those stops in, hard stops, let the order sit out there, because I don't want you to be fighting a battle every time, because it's important. If it hits your stop, you need to get out. Okay, and we'll talk in a more advanced class about what to do about those stop outs and stuff like that. So risk management trade setups. Okay, we're kind of coming into the home stretch. We're pretty much done here. It must be worth the risk to take the trade. And this is probably one of my biggest pet peeves with traders that have no idea what their targets is and no idea what their setups are. They have no idea what, where the stock's going, when they're getting out, or, they're just taking the stock because it hit some kind of, common chart pattern, and, which gives you a good setup, but they don't know when to get out. Selling is probably, I will tell you this, selling is probably the hardest technical trading piece to really master. And we will really hammer that in next couple weeks. But so risk management and trade setups, make sure your trade is worth the risk. Okay. How much are you targeting to make for every dollar you're risking? What's your risk ratio? Do you know what R multiple is? If you're not talking in R multiples, you don't know what it is, and you don't know what risk ratio is, and you obviously aren't doing this. Okay? So, and when you're doing trade setups, make sure that, we like to have at least a 3-to-1 risk to reward ratio. We want to make at least $3 for every dollar we're making, right? Some trade plans I've seen in systems have 10-to-1 risk to reward ratio. Okay? So, know before you get into the trade. And then the same thing with risk management is you don't want to overtrade. A+ setups only, where the odds are in your favor, but you don't know what an A+ setup is. Number one is if you don't know what your risk ratio is, what your multiples are. And number two is I see traders getting trades all the time, and I'm like, okay, well, it didn't work. Let's see why it didn't work. Well, okay, you were under this level, you're under this level, so the odds weren't in your favor. So what kind of trade were you taking? Okay, so make sure you're only taking A+ setups where the odds are in your favor. Don't let boredom step in, because it can. And position sizing is really important. Tomorrow, we're going to really tie it all in to really start putting some stuff in your trading plan on how to put correct position sizing together based off your risk threshold, based off of your stop loss. Okay, and based off of your trading rules. So, you're not just, going forward just trading 100 shares, 500 shares, 1,000 shares, and not knowing what that means to you. We're going to actually work on that tomorrow. And the last thing really in, risk management is, I know this is going to sound stupid with all the other crap that we talked about and you got to do, but I'm telling you, worst case scenario contingency plan. You must have these plans in place. You must think about them ahead of time. You got to think about what's going to happen if you have a personal emergency. What's going to happen if there's an unexpected market disaster? Okay, what are you going to do? What's your plan? Okay, what are you going to do if you have equipment or data problems and you're in a trade? What happens if you lose your job and you have some major life changes? What are you going to do? What's your plan if you have a psychological or discipline problem? Or you're having problems with your broker? Okay, what are you going to do? Well, first thing you need to do is you need to take that list, okay, and you need to go through each of those, and you need to list all the things that could possibly go wrong in each section. List them out, come up with solutions on how you're going to deal with each problem, and then visualize it. Rehearse each disaster, visualize it, do it on a weekend, do it, put it off to the side, put it on your calendar, because you won't do it because you're going to think it's not important, but you're going to be glad when that one thing happens that you did that, because you will be able to react immediately because you already have visualized how you're going to deal with the issue. I'm going to give you a real world example that me and Tyler had when he came down to visit me when I was trading down in Key West. We got the pandemic, so we're all spread out throughout the country trading different places. Well, I figured, if there's a pandemic going on, I'm going to go down to Key West and trade. So, I was trading down to Key West, and Tyler came down. We were going to pack up the system, and I was coming back up for this, for the holidays and stuff, back up to Maryland, where we're based out of, and so he was down there trading with me, right? And, we're trading that day before we packed everything up. We were actually going to have the first, we were going to have, I think, a class. We were supposed to have a class, and we couldn't have the class. So what happened was we were on our morning meeting, our Zoom meeting with our trade desk, our trade floors. I'm going through all the, with all the traders, our plays and what I'm seeing in the market and stuff. And all of a sudden we get cut off, right? So I look down, I'm like, oh no, I dropped internet. Right? So I said, all right, that's okay. So I go pick up my cell phone, and I pick up my phone to call Nick and, let him know, hey, can you pick up for me where I left off? Can you talk to everybody? And I have no cell phone service. So now I was in a situation where I had no internet and I had no cell phone service. You know what the funny thing is? I actually thought we were under attack or something. I thought we had like an EMP attack or something, because I'm like, wait a minute, this doesn't make sense. Why the heck is my cell phone service and internet down when they're not really related to each other, right? So that's a real world example of a disaster type situation. Imagine that happened and I had like 10 in trade positions on, and I was really hanging out there, right? So imagine if that happened. I can't call my broker. I couldn't call and communicate with anybody. I couldn't, I was in Key West, couldn't go anywhere, okay? And it was down all day and spotty throughout the rest of the day, to the point we had to cancel the class and we had to cancel a bunch of stuff. So, luckily it happened prior to me being in positions, but had that happened when I was in positions, it really could have done some serious damage to my trading account. And to be honest with you, I had not even considered that in my disaster plan. So now, what do you think I'm doing? I am considering I'm counting my lucky stars, and I am considering that in my trading and my disaster plan going forward. So I'm trying to give you this example because it's important. It can be really important. I mean, I traded through 9/11. The markets were shut down, right? You had to have a plan for that, right? You got to have a playbook for how you're going to deal with certain things so it becomes automatic. And the key to peak performance is have a set of well thought out rules that's going to guide your behaviors and withstand anything that might cause you to break those rules, Risk and discipline are not just a new investor problem. Even the brightest of minds have issues managing risk. And I'll give you a real world example. I traded through this. It was long-term capital. Long-term capital, and you younger guys aren't going to know about this. This was the all-stars of all-stars. Okay, this was if you had Ray Dalio, George Soros, a bunch of Warren Buffett, all the best bright minds of out there now as far as traders came together into one fund. That's what long-term capital was. Well, in September of '97, they reported a $2.3 billion loss on high-risk trades and was on the verge of bankruptcy. Okay, you talk about crashing markets. That you had the co-founder John Meriwether, a very famous guy. You had two Nobel laureates, Myron Scholes and Robert Merton. Okay, Black Scholes method, you heard of that, right? They were trading with such high levels of margin. Basically, they were taking huge positions with only 5% down. Okay, they attempted to diversify it out by taking long and short spreads in their bond funds, but the amount of margin was equivalent to buying. To kind of put in your perspective, it was equivalent of having $5,000 in your account and buying $100,000 worth of stock. Okay, and it almost crashed the whole market, and the Fed had to step in an emergency session, and of course they had to get bailed out. There's no such thing as having true risk, I guess, anymore. So don't think that risk management is just a new investor issue. It's something you're going to have to deal with every time, and you got to keep the ego out of it. Traders tend to know they need to watch risk and losses, but they don't have it built into their system, so they let emotions rule the decision-making process, and it's just a lack of awareness. They don't have the discipline required to manage the trades properly. Successful trading, we talked about, I repeat it over and over again. It's let your profits run, cut your losses short. Okay? Emotion, you can't control emotions, but you can recognize them. Understand this. Discipline weighs ounces, regret weighs tons. Okay? So I know this was a long class again. I apologize about that. Okay? But it is important. There's some fundamentally sound foundational things that you need to grab out of that class, and especially for tomorrow when we start really adding to your trading plan and putting in some position sizing rules and some risk management rules and stuff like that. Okay, you should at this point in the class, okay, just recapping, I'm going to do this every class, you should have a daily schedule. You should have a discipline schedule that you're following right now. You should have an emotional journal. You should have a mental peak performance plan. Okay? That's what you should have, a mental peak performance plan. You should be putting that together. You should have some kind of review and self-assessment process. Okay? That not just looks at the technical mechanics of the trade, looks at your mental performance and your distinctions. Remember, we're talking about a living document. So that living document, which is the trading plan, which is your preparation, which is going to take stress from you, you should have already started, okay? Last week you should have done and finished your vision statement and your purpose statement, okay? If you haven't, you wonder what they are, you go back, relook at those, the trading plan class, okay? And now, this week, you should be taking that vision statement and that purpose statement, right? And you should be redoing them with the new distinctions you got this week, okay? And more specifically with the vision statement now, I want you to go into detail in what your emotions look like when you sit down to trade. I want to go into how are you breathing. I want to have your processes in place. Have your peak performance plan out. Have your discipline plan. How are you dealing with these emotions? How are you going to deal with all of this stuff? How are you going to deal with at the end of the day? And you're reviewing stocks. Now you're going to add reviewing in your mental pitfalls and stuff. The more detail you go in, the more you're going to really accept and understand and have a vision for what your setup looks like and what your trading looks like. It's going to help you immensely. And this week, you should already be adding to your trading beliefs because we're going to finish that up. You should be adding to your trading beliefs, and you should have and started your mental edge plan. Okay, you're going to have a mental edge plan. It's going to be a plan that basically goes through all the processes that you're going to put in place, all the biases, how you're going to check those biases, what's the process you're going to use, the whole 9 yards. And we'll get in more of that tomorrow. I'll break it down even more. And you should be reading the book of the week, which is Trade Mindfully. That's where a lot of this stuff has come from. Gary Dayton, he's a genius. Make sure that you're reading it, because we're only scratching the surface on a lot of this stuff. You're going to recognize some things in that book that we've gone over in these classes. Repetition is the key of skill. We do that on purpose. Read the book, please. Do your homework. Keep the momentum up. And again, let's keep this momentum going, guys. Remember the bamboo tree, right? You're not going to see results right away. But, keep it going. Don't give in, because you're getting through the hardest part, and you're getting really close to becoming a good trader, or at least understanding and having a good foundation. Safe trading out there, guys, if you're trading. I'll see you tomorrow.